In mid-2025, employees at Porsche received an internal message from CEO Oliver Blume. One sentence stood out: "Our business model no longer works in its current form." For most companies, that statement wouldn't be unusual. For Porsche, it was extraordinary. This is a firm that for decades operated with some of the highest margins, strongest brand loyalty, and most disciplined cost structures in the global automotive industry. Yet within the first 9 months of 2025, Porsche's operating profit fell from 4.04 billion euros to roughly 40 million euros, a collapse of nearly 99%. This wasn't caused by a product recall, a scandal, or a sudden demand shock alone. It was the result of structural pressure building quietly across markets, technology shifts, and cost commitments until a historically stable business model stopped functioning. This video breaks down how Porsche built one of the most reliable profit engines in the auto industry and why that engine is now under strain.
Part 1. How Porsche made money for decades. For most of its modern history, Porsche operated under a model that was structurally different from almost every other major automaker. While mass manufacturers depended on volume and luxury brands chased expansion, Porsche focused on predictability. The company limited output, protected pricing, and designed its product cycle around long-term continuity rather than frequent reinvention. That approach reduced volatility and allowed Porsche to extract unusually high profit per vehicle. The foundation of this system was engineering consistency. Porsche rarely abandoned core platforms. Instead, it refined them across generations, most notably with the 911. Maintaining a recognizable design and mechanical philosophy lowered development risk and stabilized production. The same manufacturing processes could be optimized over time, while customers associated the brand with continuity rather than experimentation. This allowed Porsche to charge premium prices without relying on novelty. That consistency translated directly into margins. For much of the 2010s and early 2020s, Porsche earned roughly 17,000 to 19,000 euros in operating profit per vehicle, placing it among the most profitable automakers globally. Unlike ultra-low volume brands, Porsche achieved these margins at scale. It sold enough vehicles to generate reliable cash flow without entering mass market pricing pressure. This balance was rare and extremely effective. Porsche reinforced this advantage by tightly controlling supply. Production was deliberately constrained, incentives were limited, and dealer allocations were carefully managed. Inventory levels stayed low, discounting was minimal, and resale values remained strong. This protected the perception of exclusivity and reduced the need to chase demand through price cuts, even during broader market slowdowns. The expansion into SUVs further strengthened the model. The Cayenne and later the Macan brought higher volume and more stable demand without forcing Porsche to dilute its performance identity. These vehicles carried lower engineering risk than low-volume sports cars and generated consistent margins. By the early 2020s, SUVs made up a majority of Porsche's global sales, effectively subsidizing the development of high-performance models while smoothing revenue fluctuations. Customer behavior supported this structure. Porsche consistently ranked near the top in owner retention across key markets, particularly in the United States and Europe. Buyers frequently upgraded within the brand rather than switching competitors, reducing customer acquisition costs and reinforcing pricing power. The brand functioned less like a cyclical automaker and more like a controlled ecosystem. As a result, Porsche entered the middle of the decade with a reputation for financial discipline, stable margins, and operational control. There were no obvious warning signs in its core business. Demand had softened at times, but the model repeatedly absorbed shocks without structural damage. That stability is what makes the sudden collapse in profitability so important. The problem was not a single failed product or a temporary market dip. It was that the assumptions supporting Porsche's long-standing business model were about to be tested in ways they had never been before. Part 2. The China problem Porsche didn't control. The first major stress test to Porsche's business model came from China. For years, China had been one of Porsche's most important growth engines. It was a market where brand perception mattered, where European heritage carried weight, and where high-margin luxury vehicles could scale without heavy discounting. That assumption held through the late 2010s and into the early 2020s. By 2025, that environment had changed. Porsche's deliveries in China dropped sharply, with reported declines of more than 40% year-over-year in some periods. This was not simply a cyclical slowdown in luxury spending. It reflected a structural shift in consumer preference. Chinese buyers began prioritizing software capability, in-car technology, and perceived intelligence over traditional brand heritage. Performance alone was no longer enough. Domestic manufacturers accelerated this shift. Companies such as BYD, NIO, and newer entrants supported by China's technology ecosystem introduced vehicles with advanced driver assistance, deep software integration, and aggressive pricing. These cars were not positioned as cheap alternatives. They were positioned as technologically superior products at lower cost. For Porsche, this created a problem its historical model was not designed to handle. Porsche's pricing power relied on emotional brand value and driving identity. In China, those advantages weakened as vehicles increasingly became perceived as technology platforms. When buyers compare interfaces, autonomy features, and digital ecosystems, the gap between a legacy luxury brand and a domestic EV narrows quickly. At the same time, Porsche had limited flexibility to respond. Cutting prices would have undermined global brand positioning. Increasing feature content would have raised costs further in a market already compressing margins. The result was falling volume without a clean lever to pull in response. China exposed a vulnerability Porsche had rarely faced before, a major market where its traditional advantages no longer translated cleanly into demand. Porsche's problems didn't come from one bad decision. They came from the cost of switching to electric cars. Making electric vehicles is expensive. Making luxury performance EVs is even worse. When Porsche launched its first electric car, the Taycan, it looked like the company was ahead of the curve. Early demand was strong, reviews were positive, and the car fit Porsche's performance image. But selling an EV once is very different from building a profitable EV business. Electric cars cost much more to build than petrol cars. Batteries are expensive, cooling systems are complex, software development never really ends. On top of that, factories need to be rebuilt, workers retrained, and supply chains reorganized. All of this costs billions before a single car is sold. For a company like Porsche, this creates a problem. Porsche doesn't sell cars in huge numbers. Its whole business depends on high margins, not high volume. But EV costs only come down when you produce a lot of vehicles. Companies that sell millions of cars can spread these costs out. Porsche can't do that easily. By 2025, Porsche had already spent several billion euros upgrading factories, developing batteries, and preparing future electric models. These are long-term investments, but in the short term, they hit profits directly. The money goes out now, while the returns come much later, if they come at all. At the same time, demand for high-end electric cars became unstable. Some months demand was strong, then it slowed down. Prices had to be adjusted, incentives increased. That's a problem for a brand that normally avoids discounting. Then there were external costs Porsche couldn't avoid. Trade tariffs, especially in the United States, pushed costs even higher. Porsche itself admitted these tariffs would cost the company hundreds of millions. That pressure landed right when the company was already spending heavily on its EV transition. Put all of this together and the math stopped working. Sales weakened, costs stayed high, margins collapsed. Porsche wasn't failing because its cars were bad. It was failing because electric cars changed the rules faster than Porsche's business model could adapt. The exclusivity problem. For years, Porsche's success depended on a careful balance. It needed to sell enough cars to stay profitable, but not so many that the brand felt common. That balance is now harder to maintain. Electric cars push companies towards scale. The more you build, the cheaper each car becomes. But Porsche cannot suddenly become a high-volume manufacturer without damaging what makes the brand valuable in the first place. Selling fewer cars keeps the brand exclusive, but selling fewer electric cars makes them more expensive to produce. This puts Porsche in a tight position. If it raises prices to protect margins, demand drops. If it lowers prices to increase demand, margins disappear. Unlike mass-market brands, Porsche doesn't have room to fight price wars. Unlike ultra-luxury brands, it doesn't sell few enough cars to ignore scale completely. The SUV strategy that once solved this problem is also losing power. The luxury SUV market is crowded now. Every premium brand offers multiple options, many of them electric, many of them cheaper, and many with better technology inside.
SUVs no longer guarantee easy volume or stable profits. At the same time, Porsche cannot abandon performance cars without weakening its identity. Those cars are expensive to develop and sell in lower numbers, but they are central to the brand's image. This creates a constant trade-off: protect identity or protect margins. In the past, Porsche managed this trade-off well. In the current market, the margin for error is much smaller. Part 5. Why everything broke at the same time. What made Porsche's situation look extreme was not just the size of the profit drop, but how quickly it happened. The collapse wasn't caused by a sudden disaster. It happened because several pressures reached their peak at the same time, leaving the company with no room to adjust. First, demand slowed in key markets. China weakened sharply, and growth in other regions became less reliable. Porsche's business works best when volumes are stable and predictable. Even a modest drop in deliveries can cause problems when fixed costs are high. By 2025, Porsche was already selling fewer cars, but its cost base had not shrunk. Second, spending was already locked in. Porsche had committed billions to factory upgrades, battery development, software systems, and future electric platforms. These are not flexible costs. Once the investment is made, the money is gone whether cars sell or not. When revenue softened, those expenses didn't disappear. They stayed on the balance sheet and hit profits directly. Third, pricing power weakened. In the past, Porsche could rely on customers accepting higher prices. In an electric market filled with new competitors and fast-moving technology, that advantage narrowed. Porsche could not raise prices freely, but it also could not cut prices aggressively without damaging margins and brand positioning. This left the company stuck between falling demand and fixed pricing limits. Fourth, external costs increased at the worst possible time. Trade tariffs, especially in the United States, added hundreds of millions in additional expense. Porsche itself acknowledged that these measures significantly reduced profitability. Normally, a company might offset this through volume growth or price adjustments. Porsche had neither option available without creating new problems. Finally, the pace of change itself became an issue. Porsche's model was built for slow evolution. Products improved gradually, platforms lasted many years. Electrification moved faster than that. Software expectations changed yearly, not generationally. That speed forced Porsche to spend more often, update more frequently, and react faster than its structure was designed to handle. Individually, none of these pressures would have been fatal. Together, they turned small changes in sales into massive changes in profit. That is why the numbers look so dramatic. The system didn't bend, it snapped. This situation does not mean Porsche is collapsing as a brand. It does mean that the business logic that supported its success for decades is no longer reliable under current conditions. Porsche now has to operate in a market where costs are higher, demand is less predictable, and technology moves faster than traditional product cycles. That forces hard choices: fewer models, slower expansion, tighter control over volume, and a heavier focus on protecting margins rather than chasing growth. The larger message goes beyond Porsche. If a company with strong brand power, loyal customers, and disciplined operations can experience a near-total profit collapse in under a year, it shows how unforgiving the current transition has become. This isn't about one company failing. It's about an industry discovering that old advantages don't automatically carry forward. And Porsche is one of the first major brands to feel that reality in full.